In today's video, I am going to be breaking down 5 Canadian stocks that you can essentially buy and hold forever. There's not many companies in the world that you can do this with, but we're going to get down and we're going to check these out. So there is a little bit of a theme for today's video, and that is the Canadian banks. They are absolutely amazing holdings, and I'm going to explain why. For one, TD is very good. At the time of recording this video, it's actually one of the lower PE ratio companies in Canada, especially when it comes to the Canadian banks. Next, we're going to be looking at dividends, and literally the big 6 Canadian banks are all very, very safe dividends. There's a few reasons why I say that. And the reason is they have all been paying dividends for over 100 years, and they have never cut or canceled their dividends. They have paused them for increasing at certain periods of time, like right now, but they've never cut, as in reducing, or cancel them altogether. They have all been paying dividends, and over the past 100 plus years, they have been increasing almost every single year. Obviously, when there's recessions like 2008 and currently, they have paused increases, but they're still paying the same dividend. Now, you may see some conflicting news on this, and that's because they also trade on the American stock market, and because that they keep their dividends at the same price for a very long time, sometimes like right now, or they make small increases over time, generally on average roughly around 4 or 5% increase every single year. What you're looking at is on the American side, they'll say, oh my God, TD Bank or a Canadian bank is cutting their dividend. That's actually a lie, slightly. So it goes by currency. So if, let's say in Canada they're paying, let's say for example here with TD, you're looking at $3.16 a share over an entire year, you may not actually get that in the States because of currency conversion. It's going to be the same dividend, but in the States, currency becomes a play, and it may be lower or higher depending on the quarter. And we can see that they do usually once per year dividend increases, usually, but again, currently we don't see that happening, mainly because the coronavirus has essentially made the government and a couple of activist communities to stop the banks from increasing their dividends, but they are still paying them and still paying the exact same amount. They did this back in 2008, 2009 as well, where they stayed at 30.5 cents for a very long period of time, from about the end of 2008 to the beginning of 2011. However, you're still getting your payments. So if you're using this as a retirement or income, or just as income in general, then guess what? You don't have to necessarily worry. 2008, 2009 was one of the worst recessions that we've had in probably close to about 70, 80 years. And now we've got the one that's going on right now where the government just keeps on propping up, and who knows what's going to happen next. But still, over a 100-year period, and never cut or canceled their dividends. We see this with Royal Bank, which is always swapping with Shopify as the biggest company in Canada, also paying a pretty strong dividend as well, but it does have a higher PE ratio. And I'm really mentioning that PE ratio for a reason. It's price to earnings, so the lower that number is, the cheaper the company technically is. However, you can really only compare that PE ratio to other companies that are in the exact same sector, in the exact same country, because at that point, you'll just see numbers all over the place. And for Canadian banks, generally speaking, anything below 10 is a strong buy. Anything between 10, 11, maybe 12, depending on the year, is a good outcome. You'll probably be a good buy. And at that point, it's a good hold. And then anything above 14, 15, I've even seen it once at 16, where it's just one of those things where you just don't buy that one. You go for the cheaper ones because the one that has the higher PE ratio is generally already ran up, and it's going to probably trade sideways or slightly down for a bit. And we see this with National Bank. National Bank is one of those companies that usually when a TD goes down, National Bank goes up. So you're also going to be seeing that. It's always good to diversify when it comes to the banks because some banks will outperform others at different times of the year, and of course with different outcomes on what's happening in the entire world. Because, for example, Scotiabank is very heavily down in the islands as well as over in Europe, while TD and CIBC is starting to get into the States, but TD is into the States, BMO is really getting heavy into the States, and they're starting to expand out to the world and not just in Canada, which is good because hopefully one day our house prices will go down and it might actually hit the banks for a bit, but they'll still pay a dividend, and that's the main key there. And this is what I mean by a bank that trades sideways. Its PE ratio was kind of high, and it traded sideways for a period of time of about roughly 2 years. Of course, the virus hit, and then since then, we've learned that the Canadian banks are very well fortified when it comes to money, and they're not just making money off of interest anymore. These banks have monthly subscriptions when it comes to ETFs that they sell. For example, BMO sells a big line of ETFs. For example, credit cards as another one. Some credit cards, for example, the one I have, charges $120 or $130 a year to have. However, you can get that discounted to zero if you have over $5,000 in their top checking account. And that saves you a lot of money on a lot of other things too, which then leads me to my next point, which is they charge everybody for a bank account, which all the banks do that in Canada, or at least the big ones. And from there, what you're looking at is they will still make money from you. However, unless you have enough money in the account, in which case they just make more money off of interest and then their investments and things like that. So no matter what, they're still making their money off of you. From there, what about stuff like Tangerine, the cheaper alternative to Canadian banking that gives you some kind of an interest? Well, guess what? The big six banks, I can't remember which one owns Tangerine. I think it's Scotiabank. But Scotiabank, I think, is the one that owns Tangerine as an example. They're still making money off of that. So just no matter what, they've got their fingers in all of your money, no matter where you live in Canada. They have their fingers in it, unless you're obviously with a something like a one of those other types of non-banks, if you get what I mean. But they still own a bit of those anyways, so they've got your money. Now, this is the one I was just talking about, National Bank. It also does have a dividend as well of 2.7%. They've kind of ran up a lot recently, and that's why it's a little bit lower than the rest of the banks. You can also see that their PE ratio is a little bit more expensive too. However, remember when I said that from here to there was sideways trading with Royal Bank, and TD was also the same. We also seen during that time a nice steady increase while the others were pretty much trading sideways. Now this one did trade sideways slightly, but just before the pandemic it was going up, and if you follow that line, we're pretty darn close right now, and it's just continuing to go higher while many of the banks right now are starting to trade sideways. So National Bank is a growth story when it comes to the banks, and it has been like that for the last 5 years. I also want to point this out that they didn't get hit as hard as many of the other Canadian banks when it came to their financials, their revenue, and their earnings. And that you can also see that they do make some pretty good dividend increases as well. Until obviously recently when the virus hit, they've been stuck at 71 cents. And then there's CIBC, just to prove my point, we'll go back, there we go, CIBC, and from there, what we do see is even bigger dividend increases. That's something about CIBC that I really like, is they generally increase their dividends quite often, obviously up until recently, but they usually increase their dividends twice a year, which is kind of nice. But these are the banks. These are the Canadian banks. These are basically the companies that hold everyone in Canada's money, and they're starting to expand outwards. We've learned that they're making money hand over fist, no matter what time of the year it is, and no matter what situation the world's in. So I'm just saying that they're just a fantastic investment right now. Anyways, I want to know your thoughts. Leave a comment down below. I hope that you've enjoyed. I'll see you guys again next time.